Capital gains taxes are increasing, and on one side you got a political party telling you that everything's on fire and bad and everyone's screwed, and then you have another one saying that nothing's going to happen, it's all rainbows and gumdrops, and it's only going to affect the top 1% of the wealthiest people in Canada. With two political parties arguing like this, it can be really hard to figure out exactly what's going on, what it means, and how it might affect you. My name's Miles Noack of the Noack Mortgage Team, powered by Indy Mortgage, and today we're going to take a bit of a dive into capital gains taxes, the increases, and how it might affect you. I'm sure you've seen on YouTube, Instagram, Twitter, and everything in between that Justin Trudeau and, of course, our finance minister have been stating that this is only going to impact roughly 0.13% of Canadians because of this increase, or people making $1.4 million a year or more. However, on the other hand, you've got the Conservative Party and Pierre Poilievre stating that if you are a small business owner and have even $1 of investment gains, you're going to be paying this higher tax. He's also saying that this is going to push jobs out of Canada, small business owners, doctors, food production, and may leave Canada in a state of wanting. So, as mentioned, we've got two parties that are saying very different things, and we want to try and find out what's going on in the middle, because it feels like we've got two political parties, and they're kind of doing this. And if I'm not mistaken, their end goal is to do this, because they're all arguing the exact same thing. Benefits to Canadians, increasing healthcare, increasing schooling, increasing everything in between. And I think if we take a look at this and realize that, yes, they're arguing the exact same thing just through different means, we can really dissect this and find out what the benefits or risks of this increase could be. So the first thing we want to do when talking about capital gains tax is actually understanding capital gains tax, as there has been a bit of misinformation that's been put out there online. So before we dive deeper, let's clarify exactly what that is and how it's increasing. So currently with capital gains taxes, it's a tax on any return made from an investment. This investment could be something like stocks, bonds, or investment properties, but it also carries over into things such as cryptocurrencies and precious metals in the stock market. Now, to really dive into this, we're going to do some simple math on this. Let's say you buy an Apple share and it's $100. And you can end up selling that for $200. That means you effectively have a capital gain of $100. Now, currently in Canada, with a capital gains, you're only paying taxes on 50% of those gains. That's all that gets added into your income. So if you have an income of $50,000 and a capital gain of $100, you're going to increase your annual income to $50,050. So if we take a look at this, and let's say we're on a 20% tax rate, on that $100 capital gain that you're paying tax on $50 of, the total taxes you're paying is roughly $10. Now, under the new rules, this is going to change a bit. Effectively, June 25th of this year, they're going to be increasing that to around 66%. This means that instead of paying tax on 50% of that gain, it's the 66%. So it's going to increase the amount from $50 to $66. And effectively, if we're paying 20% tax on that, that's going to push the taxes paid from $10 to about $13 on a $100 capital gain. Now, as I'm sure we're all very similar, and when we hear a politician talk about taxes, our eye twitches a bit based on the fact that the two things you can really count on in life is death and taxes. However, there has been something created to mitigate the impact of this increase. So the Liberal government is implementing a $250,000 individual exemption. That means gains under the $250,000 amount, you'll only have to pay taxes on the 50%. Similar to the original rules that are currently in play. Now, this may make you look at this and think, okay, totally. It's only the top 1%, the mega rich, that are going to be affected by this. But if we look at the data and the information available, the number of individuals that could be affected by this could be much larger. So who's actually going to be paying these capital gains taxes? And the reason we want to talk about this on our channel is because we are mortgage brokers. And we have a number of clients who have, let's say, a rental property or a investment property or a vacation home. And that's where we're seeing a lot of Canadians actually pay these capital gains at least once in their lifetime. For example, let's say you bought a cottage in 1980 for $80,000. And all of a sudden that cottage is worth $500,000 today. That means you have a capital gains of $420,000 that you're going to have to pay tax on. Most people generally are only going to file these capital gains once in their lifetime, but it's something to really look at. And this can have a larger effect on farmers. For example, most farmers have a lot of their assets tied up into land. And that land is meant to be transferred to family or an individual that's inheriting the property. And even though that property isn't being sold to that individual, they could face taxes being based on capital gains on that property. These are the things that Pierre Poilievre is trying to argue and say that Justin Trudeau is taxing everyone. For small business owners selling a business, the new tax could mean higher taxes on their gains and therefore less money in their pocket when they sell their business. So for example, let's say someone would sell a business and make a gain of $1.36 million. Under the original rules, they would be hit with capital gains on the 50% of that being around $680,000. And they would, let's say their tax rate is 53%. That results in $360,000 in taxes, leaving them around $1 million left over to play with. Now, under these new rules, on the first $250,000 of this, they're going to pay the 50%, equaling out to $125,000. At 53% for a tax rate, that's about $66,000 in taxes. Now, the remaining $1.11 million is going to be taxed at 66%. So $732,000, that's resulting in $390,000 in taxes, giving a total of $456,000. So that's about $94,000 in differences that person is going to have to pay in capital gains under the new rules versus the old rules. The other group of people we want to talk about when we're talking about capital gains taxes is anyone that could incorporate. And one of the top people that do that, and the reason that Poilievre has brought it up, is doctors. Doctors often incorporate themselves so that they can have some tax benefits in their corporation versus their personal income. Now, they will draw from this corporation for personal use, and they're going to save money on their taxes. And what they generally do with that is they utilize those savings to purchase investments, right? And those investments are going to sit in the corporation, and the interest on those investments is going to compound over time all the way up to retirement. They're not going to get that $250,000 exemption. They're going to have to pay on 66% of the total book of assets as they start selling those assets off for the retirement. So that potentially means that they're going to pay more in tax based on these new rules than someone would personally. So the big question is Justin Trudeau or Pierre Poilievre? And the correct answer to that is, well, both of them. But they're both also wrong. If we look at this from a neutral and a objective standpoint, yes, this is going to affect a lot of the wealthiest Canadians. It's going to hit them in the pocketbook. It's going to tax them higher. And yes, this will have an adverse effect on some middle-class individuals who will face higher taxes. But at the end of the day, the Canadian tax code is complicated with many exemptions and qualifiers that make it really difficult to determine how the exact impact is going to be without detailed analysis. And when I talk detailed analysis, I'm talking like get 50 accountants in this room, all crunching numbers on different scenarios, and then we compare notes. We're obviously not going to do that. They won't fit in this room. It's too small. But like I said, it's going to affect people negatively, but it's also going to produce capital that can be utilized by the government. One thing that really makes this money too is something known as the lifetime capital gains exemption, which for the sale of certain assets such as farms or small businesses exempts people from paying that capital gains tax on the first $1 million. And that's being increased to $1.25 million. So the bottom line of this, most average Canadians will only be affected if they own something like an investment property, a rental, a vacation home, anything like that. They're going to be affected and potentially lose tens of thousands of dollars due to this tax increase. But if you're a business owner, you could potentially lose a lot more. But that's only if you're already making significant profits. Ultimately, more money will go to the government, estimated nearly $20 billion over the next 5 years that they can use for healthcare, housing, or whichever other priorities they may have in their political agenda. At the end of the day, it's a tax increase. And yes, it does make your eye twitch. But also, if they utilize these tax dollars correctly, maybe it could benefit us. Only time's going to tell. Thank you so much for your time. I hope you have a great rest of your day, and we'll chat with you soon. I think that was pretty good.